So we go to statement of financial position. When we talk about statement of financial position, it's basically talking about the assets, liabilities, and the capital of a business. So it simply means we want the worth of a business is known through the statement of financial position. But before we get into the statement of financial position, it would have meant that we're done with the statement of profit or loss and other comprehensive income. Because the profit made there will be transferred, will be added to the capital, the statement of financial position. And one thing you need to understand about the statement of financial position is that the assets, the total assets must equals to liabilities. So that's why we have an accounting statement which says accounting equation which says assets equals to capital plus liabilities. Assets equals to capital plus liabilities, which means capital is assets minus liabilities and liabilities is assets minus capital. Clear? So that takes us forward. So that's about that. Then we move on to assets. What are assets? Why do we call them assets? We call them assets because these are resources that are owned by the business. They are owned by the business. These things belong to the business. That's why we call them assets. So we have two types of assets. We have current assets and non-current assets. So I start with current assets. Why do we call them current assets? We call them current assets because these resources are expected to be with the business for a short period of time, mostly within a year. So they belong to the business, but they won't spend more than within a year. They won't spend more than a year with the business. So examples of these current assets are inventory, trade receivables, other receivables, cash, and bank. So why do we have current assets? We have current assets because they are used to turn to cash. So the intention of keeping them is to use them as soon as we need cash. That's the intention of the current asset. I think it's clear. So examples, I made examples already. So there are some examples that we didn't talk about in the statement of profit or loss, which are like trade receivables.
Yes.
For trade receivables, these are trade creditors, your credit customers. Your credit customers, they bought on credit from you. So because they bought on credit to pay at a later date, they become your trade receivables or debtors. So you call them trade receivables or debtors.
Debtors.
Is it clear?
Yes.
Then we have other receivables. For other receivables, we're talking about payments or for services that you have not you expected to get them in the future. So I could pay now, but the service is not going to be now. I'll get the service after now. So we call it prepayment. So prepayment is part of other receivables. It's part of the asset of the business. Is it clear?
Yes.
So that's about asset. Then we go to, I told you what liquidity. Liquidity simply means the ease at which resources or assets can be turned to cash. The ease at which resources can be turned to cash. That's liquidity. So that's the main reason why we have current assets anyway. So we go to non-current assets. For non-current assets, they are expected to last for more than a year. So examples are, so for non-current assets, we have tangible and intangible. For the tangible ones, they are land, building, machinery, equipment, fixtures and furnitures, plants. These are long-term assets. So they are fixed assets. They are expected to last for more than a year. Then we have intangible. For the intangible, these are assets that are of non-substance. You cannot touch them.
Yes.
But they are beneficial to the business in the long run. Example is goodwill. Example, goodwill. That's the reputation of the business. It's an intangible asset. Is it clear?
Yes.
So we move on to liabilities. Why do we call them liabilities? We call them liabilities because they are debts to the third party. So example, we have two types of liabilities. We have non-current liabilities and current liabilities. So why do we call them non-current liabilities? We call them non-current liabilities because these debts has to be paid for more than a year. You have to pay back after, they are payable after some years. Then there are current liabilities because these debts have to be paid within a year. Examples of non-current liabilities are trade payables. We're talking about trade payables, we're talking about our credit suppliers. We have to pay them within a year. Then we have the short-term loans. We call them short-term loans because they are repayable within a year. So example of a short-term loan is a bank overdraft. And even bank overdraft, you might have to pay it even within a month.
Sure.
So it's a short-term loan. Any question about that? That takes us to capital. Why do we call it capital? We call it capital because it represents the amount of money the owners of the business put into the business. It's capital clear?
Yes.
So for capital, when you are preparing your financial statement or your statement of financial position, it's always going to be capital plus profit for the year minus drawings, or capital plus capital introduced. In the course of running the business might have sold other shares, or the owner of the business might have add money to the business. So it is capital plus additional capital plus profit for the year minus drawings. So capital increases. If profit is made, then you add it to capital. If loss is made, you less it from capital. Is it clear? Any question about that? So that means capital increases if the business makes a profit, and capital reduces or decreases if the business makes a loss. Clear?
Yeah.
So that takes us to activity.
You see, I can do that the whole video. You'll be mad.
Hello. So we go to activity 7. They said the case study assets or liability. So we have description and we have to state if they are non-current assets, they are current assets or current liability. Motor vehicle.
Current assets.
Cash. Motor vehicle.
What?
Motor vehicle.
Non-current asset.
Cash.
Non-current assets.
Cash.
Asset. Current asset. I mean.
Goods for resale.
Non-current assets.
Goods for resale.
Yeah, you're gonna resell them.
Yeah.
So
They are stocks.
They're the current asset.
Current assets. Amount due to suppliers.
Current liability.
Amount due by customers.
Current liability.
Amount due by customers.
Amount due by customers. They're current assets. Not current
Yes.
assets.
Rent outstanding.
What does that mean?
Rent outstanding simply means you are owing.
Current liability.
That's accrual. Okay. Bank overdraft.
Current liability.
For office furniture.
Non-current assets.
Non-current assets. Yes.
Don't play with me. Oh, so you did an extra video there.
We go to activity 8. I said
Activity 7.
activity 7. It's okay. For activity 7 again, we have to describe if it is a non-current asset, current asset, or current liability. We have motor vehicle.
This is a non-current asset.
We have cash.
Current asset.
We have goods for resale.
Current asset.
We have amount due to suppliers.
Current liability.
We have amount due to by customers.
Current asset.
We have rent outstanding.
Non-current asset. Non-current liability.
Rent.
Yeah.
Rent has to be
current
current liability. Okay. Bank overdraft.
Current liability.
Office furniture.
Non-current asset.
Non-current asset. Thank you. So we have activity 8. We go to activity 8 now. It said identifying the asset from the list below. So you are only to identify the assets. So we have this list. State if the asset is a current or non-current asset. Inventory.
Current asset.
Money owed to supplier. It's not
Non-current asset.
No, not money owed to suppliers.
Non-current asset.
Money owed to suppliers. It's not part of the. It is a liability.
So it's none of them. Oh.
They said identify the assets.
Okay.
You have to be careful about those questions. They are trickish.
Oh.
Computer equipment. Is it an asset?
Non-current.
Is it an asset or not?
It is an asset. Non-current.
Good. Money outstanding for goods sold. Money outstanding for goods sold. That means your credit. You sold goods.
It's current asset.
Current asset. Great.
And
that's all. Then we'll go to question 2. Identify the liabilities from the following list. A loan due to be repaid to loans. A loan due to be repaid.
Current liability.
Money owed to a supplier. A loan. What is a loan? A long-term loan. Loan.
Yeah.
Non-current.
Oh, okay. Understand.
Money owed to a supplier.
Current
Current what?
liability.
Okay. Money outstanding for goods sold by us.
No, fixtures and fittings.
Fixture and fittings. Is it an asset or liability?
It is an asset.
So is it part of it?
No.
Money outstanding for goods sold.
Non-current. Non-current.
We are talking about liabilities. Are you supposed to talk about it?
No, because it's asset.
A loan due to be repaid to National Bank in 3 years.
Liability.
Which type of?
What is current liability? Non-current liability. Mister, is that non-current within a year?
Yeah, current is within a year. Non-current is more than a year.
Oh, okay.
VAT due to be paid to HMRC.
Current.
Good. A bank overdraft.
Current.
Thank you.
So smart. You see me without me, myself, and here.
So go to activity 9. They said allocating accounts, case study allocating accounts. Here, identify the nature of each item in the list and where each would appear in the financial statement. We have bank overdraft. Bank overdraft is a liability and it's going to be in the statement of financial position. Rent paid quarterly in advance. That's an asset. Quarterly in advance. That is prepayment. We call it prepayment.
Of financial position.
Statement of financial position. Good. Motor vehicle.
It is an expense.
Motor vehicle is an asset.
And it's a statement of profit or loss.
Statement of financial position. Assets.
Oh, perfect.
Factory premises is an asset. A statement of financial position. Sales of goods is an income. And statement of profit or loss. Okay. Purchase of stationery is an expenses.
Maybe
and
statement of
profit or loss. Okay. Sales of good, income, statement of profit or loss. We have purchases of stationery. It's an expenses. It's in statement of profit or loss. Bank interest received.
Can I answer from now?
Okay, that's
income.
Income and where?
Which is a statement of profit or loss.
Good. Insurance premium.
Income.
Insurance
no, expense.
Premium. Expense. Okay. Where?
Which is the statement of profit or loss. Amount owed to stationery liability. Which is a statement of financial position.
Good.
Inventory held for resale, we said that is a liability. No, that is an asset.
Asset and statement of financial position. Loan interest paid.
Loan interest paid, that's an expense, and that's
loan interest paid. Expense and what? Statement of profit or loss. Computer equipment.
That is an asset and a statement of financial position.
Thank you.
I'm so good.
Yeah, I know. Go to activity 10. Juliet runs a business delivering lunches at people's place of work. She borrowed 30,000 for her business on 1 January 2019. The loan is repayable in full in 4 years' time, but interest at the rate of 8% is payable annually. She has also financed the purchase of a delivery vehicle by a loan of 8%, which is repayable for full over 4 years as from 1 January 2020. Interest of 7% annually is payable on the loan. The business has purchased goods for resale totaling 2,100. This amount is to be paid on 15 January 2020. Show the total amount of current liabilities at 31 December 2019. So they said we show the total amount of liabilities, current liabilities here. So there's a loan of 30%, right? But since now they said, assume that no payment have been made during 2019 for interest, so there's no expenses. Because no payment was made. So since there's no expenses in 2019, so we consider it as current liability. Do you get the point? They said no payment was made in 2019.
Yeah.
So it becomes a loan. It becomes an expense.
It's
an expense, but it will be seen as the current liability because it was not paid. So 30%, we have 30,000. That's 8% of 30,000 is 2,400. Is that clear? So that's a current liability. The purchase of delivery vehicle was 8,000 and 7%. 7% of 8,000 is 560. Done. Then we have trade payables, which is 2,100. Then you add all together. Is it clear, please? So 2,400 plus 560 plus 2,100 is the total liabilities. So that's 0, 6, 5, no, 0, 0. Let's calculate it, please. We have 2,400, 560, 2,100. That's activity 10. So that takes us to statement of financial position layout. So for the layout, we're talking about the format. So the format I have here, in your statement of financial position, you have 3 columns. You have the cost, the provision for depreciation, and the carrying value. The cost, provision for depreciation, and the carrying value. The cost is the historic cost, which is the value of the asset. Provision for depreciation is the amount you have to take away for depreciation, and the carrying value is the difference between the historic cost and the provision for depreciation. So land is an asset. The provision, land doesn't have depreciation. Land does not depreciate. Land will appreciate, but building will depreciate.
Why did you?
Yeah, I took it away. Building will depreciate because building can lose value. So equipment, these are first in your statement of financial position. You start with the non-current assets. After the non-current assets, you write about the current assets. The non-current assets are land, building, equipment, fixtures and fittings, furniture, machinery, and the rest. For the current assets, we have inventory, trade receivable, cash at bank, other receivables, cash at hand. When you sum them together, you have your total assets. Then we have capital and liabilities, which are the opening capital. You had the capital introduced, then you less drawing to get your closing capital. Then we have our non-current liabilities, which can be the bank loan. It can also be mortgage. Mortgage is also
mortgage.
It's also part of our current
What the
liability.
mortgage is when paying house rent, something like that.
Yeah, so it's also part of the current liability, non-current liability. Then we have current liabilities, which are trade payables, other payables, bank overdraft. Is it clear? So the total capital and liabilities must equal to the total assets. Assets, because assets is capital plus liability. So the value for your assets must be equal to the value of total of the liabilities and capital.
Okay.
So that takes us to activity 11. Are you there? That takes us to activity 11. Are you there, please?
Okay.
So for activity 11, they said we should find the missing numbers, missing figures. So the first one, they said we have non-current assets, we have current assets, we have non-current liabilities, we have current liabilities and capital. So the first one is about finding the capital. And capital is what? Asset minus liability. So the total assets minus total liability will give us capital, which is 48,000 plus 22,000, which is 70,000, minus 14,000 plus 6,000, which is 20,000. So the total assets, the capital is 50,000. Then we have non-current assets to be looked for, which is 35,000 plus 6,000 plus 33,100 minus 17,500, which is 26,600. The third one is the current assets, which is the total of liabilities and of the capital and liabilities minus non-current assets. So we have 120,000, which is the total of asset or total liabilities, and capital minus non-current asset, which is 120,000 minus 102,000. That's 18,000. The non-current liabilities, we have the sum of the total assets minus the addition of current liabilities plus capital. So that is 148,000 minus 138,000. Then we have our non-current liabilities to be 10,000. Then we have the last one, which is current liabilities. For current liabilities, it is non-current assets plus current assets minus capital. So it is 70,000 minus 65,000, which is 5,000. Yes?
I don't understand. I'm just reading.
So we have activity 12. Are you there? Are you there, please? Yes, the following is an extract. Yeah, the following is an extract. The following is an extract from Dina's trial balance at 31 December 2019. Prepare the statement of financial position, having already worked out the profit for the year, amounted to 21,100. We have it there. So we start our statement of financial position. We start with machinery. Machinery, the value of machinery is 42,000. Are you there? Please look at it.
I'm there. Oh, okay.
The value of machinery is 42,000. That is the cost. Then we have the provision for depreciation, which is written here, 19,400.
Okay.
Provision for depreciation is there, 19,400. That gives us our net book value, or the carrying
This is
value.
non-current asset, perfect.
This is what we call the NBV, not net book value, or carrying
You
value.
split them up, non-current, current, capital liability, non-current liabilities, and incurred liabilities.
Yeah. So the first one is done, which is machinery. The value of machinery minus the provision for depreciation gives us this value. Vehicles, the value for vehicle is there. Vehicle is cost is 8,000. Then depreciation for vehicle is 5,600. You take it away. That gives us our net book value. Then investment. Investment doesn't have depreciation anyway. So the value for investment is 2,800. You add it all together. Then you go to your current assets. Our current assets here are the bank. We have our current assets. We have inventory. So we have inventory 15,500. We have trade receivables, which is 30,000. Trade receivables is 30,000. But we have irrecoverable debt of 800. You have to take it away from your trade receivables.
So you treat now 20.
Do you remember that?
9,000
debt. You have to take it away from
Yeah.
the provision. You have to take it away. So that gives us 29,200. The cash at bank, which is 700. You add them together, it gives you 45,400. So 45,400, which is current asset plus non-current asset, gives you your total assets. So your total assets here is 73,200. Now we find liabilities. For our liabilities, we start with the capital, the amount of money invested by the owner of the business, which is 38,200 owner's capital. Then we have profit. Profit is 21,100. You add profit to it. That gives us our closing capital. So our closing capital here is capital plus profit. Even we have additional capital. We add it to it to get our closing capital. So here we don't have it. So we have capital, which is 38,200 plus the profit, which is 21,200. That gives us our closing capital, which is 59,300. Then we go to non-current liabilities, which is a bank loan, 8% bank loan. It's a non-current liability. So that's 7,000. Then we have our current liabilities, which is trade payables. That's the only item left. Trade payables, which is 6,900. So 6,900 plus 7,000 plus 59,300 gives us 73,200. So our assets, total assets equals our total capital plus liability, 73,200. That ends statement of financial position. Thank you.